So did you know that banks are what is called income lenders? So what this means is that although you need to have a deposit, of course, you need to have a bit of equity, what banks are really most concerned about, what New Zealand banks are most concerned about, is your income. Because your income shows the banks that you have an ability to continue to pay that mortgage for years to come. So that is one of the most key things that a bank is looking at. So having the right kind of income and an income that the bank will accept and lend on is really, really important. So we're going to talk about incomes today and the different types of incomes and how the banks will see that. My name's Jeff Elias. I'm the founder of FutureBound, where we help people to get a mortgage and financially free. Right, so let's talk about the bank's most preferred type of income, because this will be the easiest one, and this does apply to most people. And the banks really love, most of all, just permanent PAYE income, where you've got a job and you're working for a company. Now, in the bank size, this is like permanent income. This is income that's going to keep coming in forever. Now, is it always going to be the case? Of course not. You know, some companies go broke, but you know that's not really what the bank's not going to go looking into that. They're basically going to accept that if you've got a job and you're getting paid on a PAYE basis, the bank really likes those kind of incomes, because in their minds, this is basically permanent employment. That type of income is not going away, and that's what the banks really, really like. Okay, now let's talk about self-employed income, for example. All right, so self-employed income, let's say you've gone and bought yourself a business, or maybe you've started a business and you're wanting to then go and buy a house. Well, this is the type of income that the bank is going to look quite a lot more closely at, because your company is probably not yet established at the beginning, but after a number of years, then the banks will have more confidence in your company, because there is a track record that your business has been successful. So when you're getting started, if you're planning to buy a house next year and you're wanting to start a new business this year, it's probably not a good idea. You might want to rethink that, because usually the banks are looking for 2 years of financial records, and the banks want to see that your business is being productive and is being profitable before they are prepared to lend on it. So an important little note on this. Often, let's say you've got in your business, let's say you've got $100,000 in revenue, and in your mind you've made $100,000. But then the bank will look at the expenses that have come out. So let's say you've got $60,000 worth of expenses for your business. So that means the actual profit of your business is $40,000, right? So the bank will use that $40,000 as your income, and that would be too low for you to go and get mortgage lending. And so this is where, when you're running a business, if you're planning to actually borrow money, you're better off declaring less expenses and paying more tax, having a higher taxable income, because the bank is going to look at your taxable income. Because often accountants will say, well, let's claim that, and let's claim that, and let's claim that. And that does allow you to pay less tax, but it doesn't allow you to borrow money. You can't have it both ways. All right, so I'm self-employed. My preference is to basically show a higher taxable income, and I know that's going to mean that I pay more tax, but it means that I can borrow money way more easily, and the banks will like me. All right, so that's self-employed income. Now, in the big cities, we've got a lot of people that are contractors. So they could be IT contractors, or maybe contracting for the government in a government department or something like that. This type of income is generally pretty good. The only thing you need to be aware of is that if you've just got started and it's your brand new first contract and it's only a 3-month or a 6-month contract, then the bank's probably not going to have a whole lot of confidence in that. But if you've got if we can say that you've been contracting for 2 years or for 3 years, well, then the bank is usually pretty comfortable with that type of income. Now, let's say that you've been doing software development, for example. You're an IT contractor, and let's say you've been doing software development for 5 years, working PAYE, on salary or wages for another company, and then you've gone and taken your first contract as an IT contractor. Usually that's actually okay, because we can show that there's been a track record of you doing this type of job. Right, you've been doing it for 5 years, working for another company, and now you've got your first contract, so the bank can see that there's continuity. This is not your brand new first job ever as a contract, so that in that situation is usually okay. So what we're trying to avoid here is we're trying to avoid someone saying, I've been a mechanic, and now I'm a hairdresser. All right, with their first contract, because a mechanic and a hairdresser are completely different. But if you're mechanic, and it's the same type of job, going from PAYE to being a contractor, then that shows that you've got some longevity in that type of industry, and the banks will probably still have confidence in you. So then you've got fixed term contracts. So this is very similar to other types of contracts, but once again, fixed term contracts are just similar to what I've talked about with the other types of contracts. They just want to see that there's continuity. Okay. Now let's talk about the types of income that the banks probably like the least, and that is casual income. Okay, so if you've got casual income, this means that you might be on call and they call you in sometimes, but then they don't need you other times, but then they want you again. You know, it's really erratic. So banks, New Zealand banks, and all banks probably they're just quite conservative, and so they like certainty. So this is what we're looking for. We're trying to give them confidence. We're trying to give them certainty in your type of income. And so if if it's sometimes you're getting paid and sometimes you're not getting paid, that doesn't give them any confidence. So that's why if you've got casual types of work, then that's not going to be helpful income. The other type of income that I'll just touch on briefly is like overtime income. So this is very common with nurses, but there's also other types of jobs that have regular overtime as well. And what they're looking for here is a track record. They will largely still want to work with your base income, but if we can show that, hey, there's a track record of you earning a certain amount of overtime, then that income can either all of it can be used, or a percentage of it can be used depending on the situation and the bank. And so that overtime income can make, and penal rates, for example, can make a significant difference if the servicing is tight. Right, so I hope you found that little video helpful on different types of income. If you're wanting to find out more about your situation and what you can do with your type of income, then I suggest you book a 15-minute chat so we can talk about your situation. In that chat, we will look at the type of income that you're earning, or maybe we can talk about the type of income that you need to be earning so that you can be taken seriously by the bank. So book a 15-minute chat. Look forward to seeing you. My calendar does get really full, so if you're planning to buy a house in the next 6 months, you probably want to book in sooner rather than later, and we can have a talk about your situation and see what can be done.
For more financial tips, advice, and education, subscribe to us on YouTube, and don't forget to hit that notification bell.